Hello, and welcome to Ask Matt a Question number 6. Today should be a really quick one. This is a question I get, probably a couple times a month. What are the things that I should be paying attention to and tracking to know if my financial situation is in good health? So much like when you go to the doctor, they look at certain things like your blood pressure and your heart rate, and that gives them an idea of how you're doing. So there's 5 things that at the very least I would have most people keep an eye on, if not track fairly diligently. So number one is income. What's coming in? How much are you actually making? And this can be a confusing one sometimes because you may have a salary of 100,000, but after taxes and everything being withheld, you might be getting much less than that that's coming into your checking account. So I recommend, at least initially, look at the amount that you're actually receiving that's coming into your bank account. Number two, expenses. What's actually going out? Again, this can be confusing. What I recommend a lot of people do is look at their bank account that they pay their expenses out of. Oftentimes, folks will have their bank account, but then also a credit card. And you've got to make sure that you're not double counting. So if you pay your credit card balance off each month, you don't want to add that as an expense on top of what you're already recording. So make sure you're only recording each expense once. From there, you should be able to determine how much you're saving. So for some folks, they have a separate savings account and they'll have a certain amount each pay period go to their savings account. There's some folks who look at what they have left at the end of the month and move that to their savings account. There's some folks that have automatic withdrawal for 401k plans and other retirement types of accounts. Those all count towards your savings rate. But again, some folks aren't saving anything. They're just allowing that amount, if there is an excess, to accumulate in their checking. So it's really important that you start setting that money aside in a place where it's much more difficult to access it and utilize. In the same way, a conversation I have quite often with clients is, I save 500 a month to my savings account. I ask them, so you should have about 600 or 6,000 each year that you're saving. And so that should accumulate by 6,000 a year, correct? And they say, no, I usually spend it on a vacation or something like that. Well, then that technically shouldn't be counted towards your savings. So making sure that it's only things that you're saving for future goals and things like that, not just a place where you're parking money until you spend it. Number 4, taxes. How much are you paying in taxes? And knowing the difference between your marginal tax rate and your effective tax rate. So marginal is the amount you pay on the next dollar you earn. So if you earn 100,000 and your marginal tax rate is, say, 22%, that means 22 cents out of every dollar from that point forward that you make goes to taxes. Your effective tax rate is, if you take the whole 100,000, what percentage of that are you paying in taxes? And generally, the effective tax rate is going to be much less because you have your standard deductions and you have a tiered tax system. So the more you make, each tier you move up, you pay a certain percentage in that tier, and each tier that tax rate goes up. So effectively, you're paying less over the full amount. So you might have, again, that marginal tax rate of 22%, but your effective tax rate is 12%. And so the 22, if you start earning more income, or you invest in certain ways, or you draw from your IRA, it will affect you differently because that'll affect your marginal tax rate versus your effective tax rate. So those are all things you want to know so you can actually look at how each move you make financially may affect you. And then finally, net worth and liquidity. So your net worth is everything you own minus your debts. So when you're first starting out, say you buy a home, you probably own more than you actually have in assets. And then as you continue to save, you pay down your mortgage, you start to have a net worth that is in the positive. Now, the liquidity portion is you may have 500,000 in value in your home, but that's not a liquid asset. So you only want to count the things that you can readily use towards your goals. So, for example, your checking, your savings, investment accounts, IRAs, and 401ks are generally not considered liquid because those are things that have age requirements on when you can draw on them penalty free. That being said, there are certain things you can do, such as take a loan on your 401k or take a hardship against your IRA. So there are some times when your IRA may be considered a liquid asset, especially if you're over a certain age. So if you take all of those things into account, they give you a really good picture of what your financial situation is. And those should give you all the tools to be able to make good financial decisions. One of the things that I find is someone will come to me and say, my CPA says I should do this. And you have to remember your CPA is looking at taxes and income. Those are really the two things they're looking at. And so they don't have the other three parts of the equation in mind when they're giving you advice. So we want to make sure we're looking at all five things when we make those financial decisions. I hope this was helpful, and we'll talk to you guys again soon. Thanks.